How you doing? Put this on Do Not Disturb. Thanks everyone for being here this morning. It's great to be joined by our Chief Investment Officer, Stephen Meyer, and some others of the leaders of the Bureau of Asset Management who can either help me answer more detailed questions or follow up with you if you have questions about particular things. I am very pleased to announce this morning that New York City's 5 pension funds delivered robust aggregate returns of 10.3% for the fiscal year ending June 30th, 2025, net of fees. This significantly exceeds our actuarial target of 7%, which is set by the state legislature, and marks the 3rd consecutive year of strong performance in excess of that benchmark. In addition to the 1-year return of 10.3%, we're posting 3-year return of 9.4%, 5-year return of 8.5%, and a 10-year return of 7.7%, all exceeding the 7% target set by the state legislature. Here's what that means in practical terms for New Yorkers. First, if you're a New York City retiree or an employee and therefore a future retiree, your pension is well funded. New York City's pension funds are over 80% funded for our long-term obligations for the coming decades. And that gets recalculated every year by the city actuary. But I suspect with this year's returns will actually in aggregate be around 85%. And we're on track to have the funds 100% funded by 2032. And that means city employees can count on their pensions being there when they need them. Again, that is relative to all the obligations of the coming decades. Every year we pay out a quite small percentage of the fund net asset value for this year's obligations. That 85 going up to 100% is for all the obligations in the many decades to come. And that means city employees can count on their pensions being there when they retire, which is a great thing. And this year's returns are also very good news for New York City taxpayers. Every year, the City of New York makes deposits into each of the 5 pension funds as determined by the city actuary to reflect this year's obligation. So for whatever we owe into the pension funds for the salaries we're paying this year, the actuary determines what needs to be deposited to make sure that the benefits will be there in the years to come. And when returns are above the 7% target rate set by the state legislature, as they were this year, that means the city budget is then adjusted to require lower pension obligation deposits. So this year's 10.3% returns will reduce the city's required pension contributions by approximately $2.2 billion over the next 5 fiscal years. And that means when the city approaches its budget next year, it will be able to factor in higher pension fund outperformance and therefore be able to modestly reduce the contributions that are required from this year's tax revenues. Outperformance over the past 3 years has therefore saved the city nearly $5 billion. And that's money that will be available in the city budget to cover the essential services that New Yorkers depend on every day: our schools, our parks, public safety in our neighborhoods. These strong results are a direct testament to our disciplined and prudent long-term approach. New York City's pension fund system can sometimes seem cumbersome, with 5 separate funds and dozens of trustees, with 4 of the funds balanced between 50-50 between city representatives and labor representatives. But it works to ensure a real focus on building a diversified portfolio attentive to the long term with a disciplined and strategic approach to investment. And our staff in the Bureau of Asset Management work with those trustees, with our consultants and our asset managers to develop a broadly diversified all-weather portfolio that delivers over the long term. This year's performance, no surprise, was largely driven by strength in public equities. The U.S. stock market had a very strong year, and developed ex-U.S. equities did even better. Our fixed income assets did very well this year as well. Private markets were more mixed. For the third consecutive year, infrastructure outperformed other alternative investment asset classes in FY25 and had a very strong year. Private equity returns were more muted. One reason for that was a $5 billion secondary sale that we executed in order to yield a more streamlined portfolio of high-conviction core managers that is expected to deliver enhanced value creation, strong outcomes, and operational efficiencies in the coming years. The system's increased focus on co-investments as a cost-effective source of returns in recent years as part of our ongoing efforts to continue to drive performance through no-fee, no-carry cost structures. Of course, if you based all your investment decisions on one good year, you would be tempted from this year's results to put all your assets in public equities. But that would be a mistake if you are a long-term investor responsible for delivering an all-weather portfolio that isn't driven by one-year good returns. Over the past 3 years, public equities in our portfolio have outperformed private ones, as they have broadly in the market. But if you look at 5, 7, or 10-year returns, our private markets portfolio has outperformed public markets. That's not to say that we believe that we should shift dramatically in one way or another. On my watch, as a result of an easing in the basket clause legislation in Albany that we saw in my first year, we've modestly increased exposure in private markets. But mostly we believe we have a smart strategic asset allocation, which is well prepared to provide good diversified returns and manage risks well over the long run. One thing I'll just mention is that secondary sale is very much part of that strategy. In order to achieve strong performance in private markets and private equity, it's important to aim to have top quartile managers to reduce fee and carry, and that's what that sale did. Sold off some of our longer-standing private equity investments, which come from a sort of earlier vintage in these funds' private investments, concentrated us with managers who have had really strong performance, and continue to put us in a position to increase co-investments and reduce fees for the year to come. So while I feel proud of the good returns for this year and the past 3 years, I really feel even prouder of the ways that we've repositioned the portfolio for greater success and outperformance in the years to come. And really, that's what the stewardship of this office is all about. Of course, what gets focused on is how did you do on June 30th? That's what we have to benchmark, and we feel good about this year's returns. But the real work here is long-term stewardship. And of course, my predecessors in this office built a portfolio that generated a lot of those. And what we are doing under CIO Meyer's leadership is building a portfolio that will outperform and deliver strong performance long after my tenure under controllers to come. That's the key to making sure that our teachers and cops and firefighters and public hospital nurses and school crossing guards have their and comptrollers too, have their pensions when they need them in the years to come. I want to talk for just a moment about how all of this integrates with our responsible investing strategy. While Donald Trump and red state politicians attack the long-standing common sense effort to take environmental, social, and governance risks seriously, we know that responsible investing, that taking ESG risks seriously, is consistent with fiduciary duty and with our long-term responsibility to our beneficiaries as a universal investor. And you can see that in our portfolio in a lot of ways this year. Oil and gas stocks were down this year, which meant that the 3 funds that have divested fossil fuels did modestly better as a result. Probably the single responsible or ETI, economically targeted investment, that I'm proudest of during my tenure is the investment we made to purchase, along with CPC and Related, the mortgages on the 35,000 units of rental housing in New York that were put at risk when Signature Bank failed. And I'm pleased to say that investment has stabilized all of those rent-stabilized units and exceeded the 11% hurdle rate that we sent for it, delivering very strong returns. Our MWBE asset managers continue to be among our best performers. We'll have our annual report on that work out later this fall for folks to take a look at. And data continues to show that companies who provide proxy access outperform those that don't. One great example of historic responsible investing or ESG investing work done long before I got here by our corporate governance team, pushing companies to provide proxy access. That at the time was not a standard practice. Now it is a standard practice. And data shows that that leads to small but meaningful outperformance in the markets as a whole, what's sometimes called beta activism, helping produce value more broadly across the marketplace. And that's what large public pension funds like New York City's funds can do, especially in partnership with other similar actors. And we're proud of that work, and we have no plans to back down from responsible investing or ESG risk management. And our numbers this year, our returns show that we should not. We are going to stay the course of long-term, responsible, diversified investing with a strong ESG or responsible investing program so that we can deliver retirement security to the hardworking municipal employees of New York City. And you know, I really think that work continues. You can just see so clearly why it's critical as other elements of the safety net are put at risk with cuts threatened to Medicaid, Medicare, food stamps, Social Security, the presence of a broad social safety net that makes it possible for people to go to work every day and teach our kids and pick up the garbage and fight fires and do the accounting that makes the contracts possible at New York City. Those folks deserve to know that as they retire, their families will be able to count on retirement security for many years to come, as has been the case for many years in the past. So I'm really incredibly proud of today's results, of our long-term approach to stewardship, especially proud of the work of the great investment professionals upstairs on the 8th floor in the Bureau of Asset Management, and grateful to work with our partners, our labor trustees, other city officials, as well as our consultants and asset managers and everybody who makes it possible to provide that retirement security for generations past and for generations to come. And with that, I'll be very happy to take your questions. And Oluwatona is going to manage. I think, is this your first time managing the Q&A at one of our pressers? All right. You don't have to go easy on him, but it is his first day. So I'm not his first day, his first Q&A management. Yeah, absolutely. So, you know, best practice in private markets investments is a couple of things. Aiming as much as possible to be invested with top quartile managers. You know, that's why that is not an index fund, why what our staff are doing is looking for best performing managers and investing with them. That's, you know, the whole rationale for that model. They know how to, you know, make good acquisitions, find good companies, make good investments. And you're also looking to get the best possible fee and carry structures with co-investments. I think it's, you know, in the early years of the city's private equity investing portfolio over a decade ago, there was a less disciplined approach. And so if you look at the oldest assets, they tend to have 10, 11% returns. Newer vintage private markets investments here tend to have, on average, something more like 13, 14, 15% returns. So one piece of this was kind of cleaning that up, was moving away from some of those older private equity investments. Some of it was just concentrating with core high-performing managers. The portfolio had really grown to having quite a lot of managers, and we still have plenty. But we repositioned to be, you know, with ones we have really good conviction will be strong in years to come. And another thing we've been able to do more recently is have better fee structures, emphasize co-investment, and take other approaches that leverage our size and scale to get lower fee and carry. So this was a sale of some of the older, potentially less well-performing investments to put us in position to make a round of investments that will continue to grow in the ways that we believe our portfolio is reflecting now. Obviously, doing that involves some, taking a modest hit, and that is reflected in this year's numbers. Yes. I mean, it's a good dialogue we have when we talk about ESG goals across markets. As many of you know, we put on the public market side, our public markets managers for June 30th had to submit to us their decarbonization plans. That'll be true next June 30th for our private market managers as well. When we initially divested fossil fuels, that was in public markets of fossil fuel reserve owners. We then took the additional step of a forward-going exclusion of upstream fossil fuel infrastructure in our private markets investments that was adopted 2-ish years ago. And, therefore, private markets managers didn't bring us those assets. We are in a dialogue about midstream and downstream infrastructure. I have said publicly that I would like to see New York City move away from midstream and downstream fossil fuel infrastructure investments. I don't think we need any more pipelines or liquid natural gas terminals given the future that we're facing. Of course, the asset managers, investors, consultants, have diverse perspectives on that. That's not a decision that the funds have yet made. And as we talk to the boards about it, I'll make the case for why I believe that's the right thing. And other stakeholders, investors, consultants will reflect a diverse point of view. Once the decision gets made by the funds, our managers will respond and bring us investments that comply with our policies.
Hi, Sweeney from the Finance. Your allocation to private credit is standing below the industry average of more than 7%. Do you have plans to adjust that ratio? Second question, do you have plans to do more secondary P sales down the road?
Okay. So one thing I'll note is alternative credit did relatively well this year. As you note, it's a relatively modest allocation, but it had a strong year. As I mentioned, really one of the first things that I did when I got to the office 3 years ago, or 3.5 years ago, was go to Albany to get a little more room to invest in private markets more broadly. So New York State has something called the Basket Clause, which restricted public pension funds, private markets investments to 25% of the portfolio, while most of our peers are 30 to 35%, and some, a good deal higher than that, broadly in private markets. So I spearheaded the effort to win legislation that raised the cap from 25 to 35%, and that gave us some more room. In that next strategic asset allocation that we did subsequently, the decisions were made across the 5 funds a little differently, but to grow modestly, to grow a couple of percent in private markets, including in alternative credit. It will likely make sense to look again at the strategic asset allocation. The team is already beginning to do some of the research to lay the groundwork for that. I think it would be responsible to let the next controller oversee the decision-making in partnership with trustees about the asset allocation, given that I've got about 6 months or 5 months left here. But we'll lay the groundwork for that. The fact that the basket clause is up at 35% leaves more room broadly in private markets. Our performance in private credit is good and might argue for an increase there. One thing I will say, and this is a plea, and broadly, I feel really good about the ways that we have worked in partnership with our trustees and with the funds to do well in private markets investments, including alternative credit. You need good staff to be able to identify good managers. And frankly, we have struggled to keep up with both the salaries necessary and the scale of staffing investments necessary for best-in-class private markets management. And I hope that our trustees, in partnership with our office for the next 5 months and with the next comptroller, will provide the resources necessary to help make sure we are staffed well to achieve success in alternative credit and other private markets. Oh, secondary sales. I don't know whether we have any secondary sales in the works at this time. Steve, come on up and speak from the mic.
So nothing in the works at this point, but it will be a part of our toolkit going forward. We had a good experience in terms of the secondary sale, in terms of the size, the number of participants were over 80. So actually the portfolio has been streamlined and very well positioned. It's not to say at some point down the road we may not want to tweak some of the holdings.
And I'll just note in general, Steve comes from a whole career in public markets investing, and that's where his sort of career and passion is, but has been a good leader at this moment when, even though, as I say, over the last couple of years, public markets have outperformed, we have nonetheless modestly grown our increase in exposure in private markets. And again, that just really reflects a long-term stewardship point of view. Well, it will definitely increase. I don't know if we have a target by how much.
For this private equity general, we're actually still ramping up. So as Brad said, we had changes to the basket clause, which we initiated with legislation. Was signed into law in 2022. There's a 5-year ramp up here. So we want to get vintage year diversification. So most of our targets are on 10%. One fund actually has a 12% target for PE, one of the 5 plans. But we're getting there over a 5-year ramp up here to
This is a question, as I understand it, specifically about whether we've got a target for co-investments as a share of PE investments. So we did not divest from Israeli bonds. We did not repurchase or purchase new Israeli bonds when the most recent ones expired in the first half of 2023. Let's see how to say this. Like, Israeli bonds have a return of about 5%. We posted returns this year of 10.3%, so a portfolio invested entirely in Israeli bonds would have underperformed ours by 5%, which I think on the math would mean taxpayers owed about $4 billion more into the pension funds if that was their portfolio rather than this portfolio. That said, you know, the Israeli bonds that matured in the first part of 2023 were $30 million out of what's now nearly a $300 billion portfolio. Our investments in Israel currently, mostly in Israeli companies and Israeli public equities, but also some real estate, total around $300 million. So, you know, the decision really consistent with our cash management policies, not to repurchase. I mean, again, that bond was sitting at the cash management desk, which is by policy has assets with maturities of less than a year, and those bonds have maturities of 2 to 10 years. We're invested in no other foreign sovereign debt, either at the cash management desk or broadly throughout the portfolio. So, you know, that's simply consistent with best management at our cash desk, and certainly, as you can see, broadly with strong responsible returns across the portfolio. Well, the fire and police funds are invested in, have meaningful investments in renewable energy. So, you know, the decarbonization strategy is really a four-part strategy. It's track your emissions, engage with companies and work with them to reduce their exposure, divest where deemed appropriate and necessary, and make big investments in a shift to renewable energy. And both fire and police are absolutely part of the fourth strategy of growing their exposure in renewable energy. Those two funds have not adopted the first three parts of that strategy. And, you know, this gets back to what I was saying about the model we have here. The funds have 50-50 board membership. And what I have found is that there is a lot of broad consensus across the labor trustees and the city trustees about what's responsible investing for their beneficiaries. Everyone generally is a member, so they really want to make sure that and they represent members, and we all work hard to make sure that we're invested in a solid portfolio. There's good dialogue about some investments. There is a belief in those funds that responsible investing is part of that. Those funds have engaged in shareholder activism around workers' rights, being represented by unions themselves. The fire fund led the way on a company with asbestos risk, and was the leading investor nationally challenging one of its companies to change its practices, understanding the risks that are posed to workers. So we have those dialogues. We look for areas of consensus when we find something that we think matches the responsible investing approach that they have. We bring it to them and work together to do it. We don't try, you know, we're always in dialogue. So I mentioned that I'm going to be bringing to all the funds a proposal for excluding midstream and downstream fossil fuel infrastructure. I'll share that point of view with the fire and police trustees as well. But one thing I think that's actually been good, I guess I haven't talked about this publicly before, but, you know, the prior controller consolidated all of the pension fund board meetings into a single meeting. And as I've talked to people, on the one hand, that did reduce the burden on the staff in the Bureau of Asset Management, who then didn't have to present a shared investment across the 5 funds 5 times. But it had other consequences, which was the trustees were in a much diluted space where the voices were less heard. And it was harder to get consensus on some of these things. There would not have been consensus across the 5 funds on some of these things in the past. And we have found this works well. And with those funds, we look for consensus. Sometimes one fund, so for example, I mentioned the Signature Bank investment. NYSERS was eager to do that. So that one sits totally with NYSERS. I hope that the firefighters and police officers will come to recognize even more powerfully that climate risk is financial risk, and move forward with a decarbonization strategy that matches the three funds that have divested fossil fuels. And at the same time, I respect their membership and the decision-making structures that are in place, and we work together to take votes where we have majorities.
You say in April that you will be replacing managers that fail to submit sufficiently strong net zero plans. Could you update on that, please?
So those are the plans that were due on June 30th, and I'm pleased to say all of our public markets managers submitted plans in response. So for the starters, no one failed to submit, and we have, I don't know, a couple hundred, what's the right? 50 total public sector managers, and all of them submitted plans. We are currently in the process of reviewing them. They're detailed plans, and we'll have more to say in the coming months about them. Yeah, I mean, I guess let me distinguish between sort of national, global, and New York City metro area specifically. At the broader scale, as I mentioned, while U.S. equities did well this year, developed ex-U.S. equities did even better. We don't have a current plan to change asset allocation amongst those strategies. You know, there'll likely be a new asset allocation that will look at those questions, but I don't suspect it'll make any significant change. For what we call economically targeted investments, I'm actually pleased to say we're working really hard at this. So the funds have a vote of the boards to have up to 2% of the portfolio invested in what we call economically targeted investments. That means investments in the metro region. And we currently have about half that, roughly 1%, in those kinds of investments. Those are overwhelmingly in housing. There's a program called PPAR that we do with the Community Preservation Corporation. We have investments with the AFL-CIO Housing Investment Trust and a series of managers for affordable and workforce housing in the metropolitan region, largely within the 5 boroughs. I mentioned the Signature Bank investment, which is the most significant one of those on my watch. But mostly that program is things we've been doing a long time. The PPAR and AFL-CIO investments are like 20-year, you know, there's new investments that come, but the model is about 20 years old. And we've got about half of it, you know, half of that 2% in ETIs. So we did a thorough review, brought some consultants in to think about what more we could do. We've hired a new deputy chief investment officer for responsible investing, Valerie Redhorse Mole, who's got decades of experience doing exactly this work. And she's in the process right now of putting together a plan, and she's briefed the trustees, and we'll be continuing to do that, absolutely, about how we can grow economically and targeted investments toward that 2%. Obviously, there's appetite to do even more in affordable housing, but also in other areas like small business lending, community financial institutions like credit unions, access to capital for firms, you know, trying to do business with New York City, other opportunities that might arise. And I don't know how much of that will happen in the remaining 5 months of my tenure, but it's another area where I'm really pleased that what we're bequeathing to the next controller is a strong platform to grow those investments.
Related to the affordable housing thing, I've been hearing a lot of attention to taking a look at affordable housing because the affordability crisis is frankly making it a more interesting investment, which is sometimes in conflict with the politics. So you want to invest in the place where your pensioners work and live, but you don't want to increase rents at market rates. Does affordable housing sit within the ETI as a social investment for New York City pensions, or is it a real
This is actually a great question. It is very related. So historically, even though we have had this 2% ETI opportunity, the investments themselves have still sat on the books of the asset class that reflect the type of investment that they are. So those investments sit in our real estate portfolio and are evaluated as real estate investments. So the Signature investment was evaluated as, by our real estate asset class head, John Gluzak. As I mentioned, that one has an 11%, kind of hurdle rate. And we are looking at the possibility of bringing to the funds the idea of sitting those ETIs, in their own book, essentially, for purposes of evaluation of their returns, which might open up more opportunities for things that would be sound investments, but would contribute to the portfolio broadly in terms of risk, return, and impact. No decision has been made there, but I think it's a question worth asking. And yes, there's a lot of these tensions. I suggested on the campaign trail a model of investment that would co-invest along with municipal employees whose pension fund it is, to enable them to purchase houses they might not be able to afford otherwise, which would be great for municipal employees. That's a good investment if you're confident that asset values are going to rise in the region you're investing in, which is indeed an acknowledgement of a lack of affordability in the marketplace. Now, we could never do that at a scale that would affect the marketplace, so we wouldn't be driving up costs, but there's certainly would be a kind of ambivalence in investing in a strategy that's helping our folks buy homes, but reflects the likelihood that tightness in the market will cause asset values to rise, so home prices to rise. These are much broader challenges that aren't going to be solved exclusively through pension fund investments, but we have been very pleased with the investments that we've made in affordable housing broadly. And I guess I'll just say another sentence on the Signature investments, because I think there's a real strong likelihood that if we and CPC and Related had not stepped up to buy the mortgages on those 35,000 units, that a bottom feeder would have. They might well have been a very attractive investment, given that they were being sold at a big discount to someone who would care a lot less about whether those buildings were preserved as rent-stabilized and affordable rental housing in New York City, and whose mission was just to see rents rise as quickly as they could in order to make as much money as quickly as possible. So that's a good investment, for New York City, but it's also a good policy for New York City to keep that housing stable. Andrew Cuomo is always just in it for himself. He doesn't care about Jews or Palestinians. What he cares about is Andrew Cuomo. So when he thinks it's in his interest to demonize Jews, as he did with Orthodox Jews during the pandemic, he'll do that. When he deems it in his interest to demonize Palestinians and sign up to be Bibi Netanyahu's counsel, despite the fact that he is imposing mass starvation on the people of Gaza, he'll do that. And I think New Yorkers can see right through it. I think New Yorkers can see that he's simply weaponizing other people's trauma and conflict in a way that won't keep Jews or Muslims or Israelis or Palestinians or New Yorkers safe. How do I really feel?
How do you see the general election taking shape?
I thought that Assemblymember Mamdani put it well as like somebody who went for a job interview, was told they didn't get the job, and then still showed up on Monday. New Yorkers delivered Andrew Cuomo a resounding message on primary night. He is not the future of New York City. His time as a leader is in the past. And I'd be glad to buy him a rocking chair so he could sit by the lovely fountain at Terminal B of LaGuardia, which is lovely. I think it's a great fountain, and maybe he could sit in a rocking chair and admire the fountain and his handiwork. But New Yorkers don't want him as the mayor of New York City. I am proud, not in my role standing here in the office as comptroller, but as a, as a person, to be a supporter of Zohran Mamdani. He has really excited New Yorkers at this dark time in our broader national politics. He has excited New Yorkers and brought a real hopefulness into our politics, and I'm proud to be supporting him, and I'm very confident he'll win in November. Thanks, everyone. Nice to see you all. Oh, yeah, and special thanks, BAM team, Steve and Ed, everybody from BAM.